Chapter 3, Business Organizations, from Economics, Principles and Practice, covering corporations, beginning on page 67. Corporations. Main idea. Corporations are one of the most important forms of business and can easily raise large amounts of financial capital. Economics in you. Do you know someone who works for a corporation? Read on to learn how corporations are organized. Corporations account for only about 1/5 of the businesses in the United States, as shown in Figure 3.1. Although they are responsible for a majority of all sales, a corporation is a form of business organization recognized by law as a separate legal entity with all the rights of an individual. This status gives the corporation the right to buy and sell property, to enter into legal contracts, and to sue and be sued. Forming a corporation. Unlike a sole proprietorship or partnership, a corporation is very formal in legal arrangement. People who want to incorporate or form a corporation must file for permission from the national government or the state where the business will have its headquarters. If approved, a charter, a government document that gives permission to create a corporation, is granted. The charter states the company's name, address, purpose, and other features of the business. The charter also specifies the number of shares of stock or ownership certificates in the firm. These shares are sold to investors called stockholders or shareholders. As shown in Figure 3.2, stockholders then own a part of the corporation. The money gained from the sale of the stock is used to set up the corporation. If the corporation is profitable, it may eventually issue a dividend, a check that transfers a portion of the corporate earnings to each stockholder. Scrolling down to Figure 3.2, stock ownership. 1. You have a certificate of stock, which gives you a portion of the company. So here you see that the company portion of ownership is 1/200th. So you'd own a segment of the corporation. If a corporation has 200 shares of stock, and you could divide the firm into 200 equal parts, the owner of the single share of stock would own 1/200th of the corporation. Economic analysis. How does common stock differ from preferred stock? Moving back to corporate structure. When investors purchase stock, they become owners with certain ownership rights. The extent of these rights depends on the type of stock purchased, common or preferred. Common stock represents basic ownership of a corporation. The owner of common stock usually receives 1 vote for each share of stock. This vote is used to elect a board of directors, which in turn directs the corporation's business by setting broad policies and goals. The board also hires a professional management team to run the business on a daily basis. Preferred stock represents non-voting ownership shares of the corporation. Because the stock is non-voting, preferred stockholders do not have the right to elect members of the board of directors. However, preferred stockholders receive their dividends before common stockholders receive theirs. If a corporation goes out of business, preferred stockholders get their investment back before common stockholders get theirs back. In theory, a stockholder who owns a majority of a corporation's common stock can elect board members and control the company. In some cases, the common stockholder might elect himself or herself or even other family members to the board of directors. In practice, this is not done very often because most corporations are so large and the number of shares held by the typical stockholder is so small. Most small stockholders either do not vote or they turn their votes over to someone else. This is done with the use of a proxy, a ballot that gives a stockholder's representative the right to vote on corporate matters. Although the corporations differ in size and industry, they generally organize in similar ways. As Figure 3.3 shows, the day-to-day operations of the corporation are divided into different departments headed by vice presidents, who in turn report to president of the company. Neither the president nor the other employees of the corporation have direct contact with the owners or shareholders of the company. Figure 3.3, Corporate Structure. Notice at the top you have the owners or the shareholders, and they elect the board of directors. The board of directors then select the president, and then the president hires a vice president of sales, a vice president of production, a vice president of finance. Then notice below each vice president, you have more leadership. So under the vice president of sales, you have a domestic and international branch. Under vice president of production, you have quality control, and then you have research and development. And then under the vice president of finance, you would have payroll. And under each of those, you would have more individuals that would be working within those branches. This organizational chart shows the chain of command of a typical organization. It also outlines the basic components of the business, such as sales, production, and payroll. Economic analysis. Who reports directly to the vice president of production? Moving back to advantages of the corporation. Advantages. The main advantage of a corporation is the ease of raising financial capital. If the corporation needs more capital, it can sell additional stock to investors. The revenue can then be used to finance or expand operations. A corporation may also borrow money by issuing bonds. A bond is a written promise to repay the amount borrowed at a later date. The amount borrowed is known as the principal. While the money is borrowed, the corporation pays interest, the price paid for the use of another's money. A second and very important advantage is that the corporation provides limited liability for its owners. This means that the corporation itself, not its owners, is fully responsible for its obligations. To illustrate, suppose a corporation cannot pay all of its debts and goes out of business. Because of the limited liability, stockholder losses are limited to the money they invested in stock. Even if other debts remain, stockholders are not responsible for them. Some firms will incorporate just to take advantage of the limited liability. For example, suppose Mr. Winters, who owns the hardware store and the auto repair business, now decides to set up each business as a separate corporation. If the hardware business should fail, his personal wealth, which includes stock in the automobile repair business, is safe. Mr. Winters may lose all the money invested in the hardware business, but that would be the extent of his loss. From a broader economic perspective, limited liability enables firms to undertake potentially profitable ventures which are inherently risky. For example, corporations rather than individuals usually introduce new medicines because of the limited liability feature. A third advantage of a corporation is that the directors of the corporation can hire professional managers to run the. This means that the owners or stockholders can own a portion of the corporation without having to know much about the business itself. Another advantage is unlimited life, meaning that the corporation continues to exist even when ownership changes. Because the corporation is recognized as a separate legal entity, the name of the company stays the same, and the corporation continues to do business. This leads to a fifth advantage, the ease of transferring ownership of a corporation. If a shareholder no longer wants to be an owner, he or she simply sells the stock to someone else, who then becomes the new owner. As a result, it is easier for the owner of a corporation to find a new buyer than it is for the owner of a sole proprietorship or a partnership. Disadvantages. Because the law recognizes the corporation as a separate legal entity, the corporation must keep detailed sales and expense records so that it can pay taxes of its profits. This leads to the first disadvantage, the double taxation of corporate profits. Double taxation means that the stockholder dividends are taxed twice. They are taxed the first time when the corporation pays taxes on its profits. Then they are taxed a second time when investors, as the owners of the corporation, report their dividends as personal income. Another disadvantage of the corporate structure is the difficulty and expense of getting a charter. Depending on the state, attorney's fees and filing expenses can cost several $1,000s. A third disadvantage of the corporation is that owners or shareholders have little voice in how the business is run. Shareholders vote for the board of directors, and the directors turn day-to-day operations over to professional management team. The result is a separation of ownership and management. This is different from the proprietorships and partnership, where ownership and management are usually one and the same. Finally, the fourth disadvantage is that corporations are subject to more government regulation than other forms of business. Corporations must register with the state in which they are chartered. If a corporation wants to sell its stock to the public, it must register with the Federal Securities and Exchange Commission, SEC. It will also have to provide financial information concerning sales and profits to the general public on a regular basis. Even an attempt to take over another business may require federal government approval. Did you know? What's a public corporation anyway? It's one that has gone public, which means anyone with a little extra cash can buy stock and own a part of the company. A privately held corporation, on the other hand, sells shares only to a select group of people. Sometimes that group may consist of a few family members. The Securities and Exchange Commission, SEC, was set up in 1934 to regulate the sale of stock by public corporations. This concludes Chapter 3, Section 1, Business Organizations, from the Economics Principles and Practice textbook.